All right, everyone, Marco Palmero, founder of Ulysses in Dubai. Welcome to another episode of Acquisition Case Studies, where we analyze some of the transactions I've been involved in here in the UAE or in the Middle East. And we kind of like talk about challenges and problems that we faced when negotiating these deals for ourselves or on behalf of some of our clients. Again, this series is focused on mistakes and challenges when doing deals in the United Arab Emirates in Middle East, so that I can potentially contribute to the journey of business leaders, entrepreneurs, or private investors looking to buy assets here in this part of the world. So again, I'm going to be taking out some case studies from the deals that we discussed. We're going to break them down following our 5 steps, which are the usual ones: years of operations, key staff, real estate part of the deal, reason for the sale, and financial aspect. And then I'm going to comment with you the reasons why this deal had problems. Did it close? Did it not close? And what is the lesson that I took away and what I learned in negotiating that deal here in the region. Today, I got a very interesting transaction which we found on behalf of one of our clients. So it was an off-market deal that we sourced during one engagement. So I'm not going to be sharing a lot of details with you, simply because we maintain confidentiality in the deals that we source on behalf of the clients. But I can still give you a bit of detail to kind of give you a little context around what the deal was all about and what were the problems that happened during the deal. Now, the transaction itself was a business that had been in operation for about 17 years, so a very stable business. And the number of employees working at that business were around 23, with probably 6 of them being the ones that really were the revenue producers, right? The real estate was part of the deal. There was some office space included in the deal, which had some challenges which we're going to address later. And the reason for the sale was that the guy wanted to fundamentally transition out of that particular business line and focus on other investments he had in real estate. So fundamentally wanted to take the business, go in semi-retirement with the cash he could collect and start investing it into properties so that he can collect income from those properties. He already had a few properties and he wanted to increase that portfolio. So I think the key reason was retirement and building up his portfolio, and fundamentally he was tired of doing what he was doing at the business. So we sat down with him and we initially screened the deal to make sure he was matching the criteria of our client. And of course, we did a little bit of soft due diligence beforehand so that we can actually understand whether or not the business was a deal that could be closed and stuff like that. And after an initial discussion, we came to the conclusion that the deal was a bit pricey, but it could be a suitable candidate for that particular company that we were working with. In terms of the financial aspect, a breakdown was a business generating around $6 million a year in revenue, in about 2.5 in net. So not a bad business, right? An okay business. And I guess the challenge from a pricing standpoint, which I mentioned before, was that the guy was looking at, give or take, 12-13 million for the business, so a multiple of 4.8/5. So a bit pricey in terms of how much we are open to pay for these small assets here in the region, and I'm sure that is the case across the globe. But of course, it depends on the industry, it depends on a lot of different factors, which I'm not going to dive into for confidentiality reason. Let's just put it this way: it was a bit pricey compared to how other assets were trading in the same market, in the same geography and stuff like that. But again, provided that was okay for our client, there was no problem. And we could also structure the deal in, a suitable way so that they can offset some of the risk that they were taking on up front by delaying payments, having an earn out and stuff like that. Now, a couple of problems that came out after we started digging deeper into the deal, and once the accounting team of our client got involved. First problem was that the client was getting rid of the real estate, which was not on the company's books, but it was in his own name. So fundamentally what he did was he bought the real estate out of the company proceeds, but then he put the real estate under his own name, which is, again, common practice for small business owners who don't differentiate between a business and his own in their own personal figure. So they think both things are the same, and they draw down cash from the business as it was their personal bank account. But again, I think that was something that could be solved and could be addressed, provided the legal team of our client was able to manage that challenge. I think the biggest issue that happened was another, which came out after, and once we started to sit down with him. And I think this is a dynamic that a lot of people face here in the region, and some of them get pissed off by it, but it's just the way it works. So the client of ours was a very reputable company, right? So very established business with a lot of location, 9-figure revenue performance year over year, solid profitability, a business that had been around for decades, really. So a very solid enterprise. It was reputable, it was international, and it was looking at small assets that they could buy and put together in UAE and Middle East. So the moment these guys sit down with the owner, and the owner started to understand a bit more who he was dealing with, he kind of got quite excited, right? Because he said, fuck, I'm never going to have an opportunity like this again. I'm sitting down with a big fish who's not just a regular investor with a bunch of money. He's a big company with fat balance sheets that might be open to pay more for this business, right? If they're really committed in the region, if they really like the deal. So the mental process that started to go through this guy's mind was, well, the price I said I was willing to accept early on is simply too small, simply too low, because these guys are big fish. So I'm going to ask for a lot more, and I might get it, right? And that's exactly what happened, right? It is exactly what happened. After we started negotiating the deal a bit more, and the guy kind of got to know our clients, he started becoming very unreasonable with the price demands. As I mentioned to you before, he was asking for, give or take, 12, 13. All of a sudden, he started asking 25. Non-negotiable, right? And I immediately saw through it because, again, I've seen many other deals that went down that avenue. But our clients were kind of puzzled, and to some extent, they were also pissed off. And I can't blame them, really, because they felt kind of like insulted, like you change your pricing just because we are a bigger organization. And I think, of course, that is the reason why the deal was killed, right? And it didn't go through because our client decided, we don't want to be involved with a guy like this. We know we don't even want to have a conversation, really. It's going to be a nightmare. But I think what that showed as a lesson for a lot of people looking at deals here in the region is that you got to be extra careful when you dive into negotiations and you start talking prices and terms with people, because people here will not really have a one figure in mind that is always the same independently of the person they're sitting with. I've been in other places, Europe, United States, and the price difference that people might ask for a deal can vary plus or minus 10%, right? Depending on the person they're sitting with. But it's not going to be a huge change, right? A huge difference. Here in the Middle East, it's a jungle. I mean, the guy, the moment he realized he was talking with somebody big, he asked twice as much money. And I think big organization coming here should be accustomed to it. At least, I'm not saying they should accept it. I'm saying they should understand that a lot of people will behave in that manner and learn how to work around it to get their point across. Because one of the challenges that we face primarily in the United Arab Emirates is that many times big private equity groups or big organizations come in, they want to buy assets, they have a mandate, they have somebody else's capital, so it's not that risk. They're going to put down capital very, very fast. They're going to buy everything 100% cash up front, and they're going to overpay for these deals. These dynamics will create a very toxic environment where people are going to start to believe that that is the market, but in reality it is not, right? And they're going to start to believe that they can ask crazy amount of money when a big player comes in. They're going to become very unreasonable, and they're going to do these stupid mistakes that ultimately are going to cost them the deal, because I know this business and I know it is still available for sale, so he hasn't sold. But again, I think a lot of big companies need to be aware of how they're going to be treated and seen when they start to enter this region. People are going to some respect, try to take advantage of you and of your balance sheet. Of course, I'm sure that is no news to you, because many other people have tried that in the past, and certainly you know how to deal with that better than I do. But if I can give you my 2 cents on the region in the UAE in this case, it isn't something that should upset you too much, because it is just the mentality that a lot of people have here. It's almost like a bargain. A deal is almost like a bargain. And if you push back strongly, they might then fall back and give the deal away for much less than it's actually worth. I've seen many different scenarios where just negotiating very, very hard could drive the price down a lot. And of course, a lot of people might not even want to have a conversation, and they might say, well, you're insulting me with that. I'm not even going to consider the deal, and I'm going to look at another opportunity. But if you think the deal is really good for you, it might be worthwhile to work around this mentality and try to find the holes in that strategy of theirs, because of course it has many problems. Asking for this crazy amount of money has no justification at all. They have no reason for asking that amount. They have no financial backing in paperwork to demonstrate the business is actually worth so much. So that argument can fall apart quite quickly, and after that you can basically demand the price that you want and the terms that you want from the guy, if he's really interested in selling the business. But I think this is more like a lesson for people who are looking at entering the region the first time and they're potentially negotiating deals, because I'm already quite familiar with this type of mentality, and sometimes I see people getting upset because of it, but in most cases it's going to be just the reality of doing deals here. You might want to go through the painful process of going back and forth many times and starting from a price that seems completely unreasonable, and just drag the guy down until it finally realizes that was horseshit, right? I've seen business owners ask as much as 10 times more than the business was worth, simply because they were sitting in front of a big guy. Because the mentality here of a lot of people, not me, but a lot of business owners, a lot of small business owners, is, fuck, I'm in a country where there's a lot of wealth, a lot of wealthy people, there are royal families. If a guy that is very, very important is sitting in front of me, I'm going to try to hit the jackpot so that I can retire on a tropical island and do nothing for the rest of my life. It might sound harsh to say this, but it is just the reality of things. People think that way. They're like, okay, I'm gonna come to UAE, start up a business, run it for 2-3 years, or maybe more, and then when the opportunity comes along, I'm gonna try to cash in like I'm in Vegas. And very few of them succeed with that. Sometimes, again, they get the private equity group that buys them out, but those cases are very, very rare. In all other cases, you gotta beat them down until they come to the realization that they're saying a bunch of crap. So people who are open to that idea in terms of buying businesses might get deals across that other people would have just passed on. Again, in the case of this particular client, they said, okay, you're just Marco, you're just sourcing so many deals for us. We don't need to spend time on this. This guy is an idiot. Let's move on to the next one. And they were kind of lucky because they were working with us for DealFlow. And so we had a consistent stream of transactions that we already built for them. We were seeing, at that time, we saw 20 deals in a week. So they already had plenty of opportunities to visit and stuff like that. But in the case of somebody else, or someone like you who might be looking at deals on its own, getting fooled and getting trapped into that mentality might be a dangerous thing. And so I just want you to be aware of it. I'm sure you know about these things because if you're looking at acquisitions and you are a sizable business, you know that people are going to try to ask for more money. But the point is, that thing is going to be on steroids here in the Middle East. If you're open to negotiating hard with these guys, you can get good deals across. And again, that has been our experience for this deal. Hopefully you can get some value out of it. And I will then see you in the next one.